second White House administration of Donald Trump is now just days away. He'll take the oath of office on Monday. Many market watchers are convinced that some of Trump's key election promises, like huge tariff barriers and widespread deportations of illegal migrants, will trigger a resurgence of inflation in the U.S. economy. Our next guest, however, says those predictions could not be more wrong. We're now joined by Jay Hatfield, CEO and portfolio manager at InfraCap. He joins us from New York. Jay, you do indeed have a contrarian view on the tariff issue. The conventional wisdom is that those tariffs will make products more expensive in the U.S. economy and therefore fuel inflation. Why do you disagree?
Thanks, Paul. It's great to be on. Well, we think that it's natural. Probably well over 50% of major investors did not vote for Trump. So it's perfectly understandable to sort of believe the worst, your one's worst fears or the worst campaign rhetoric that came during the actual political season. But now we're getting the nominations. Scott Bessent is testifying right now. And we believe, and if you start listening very carefully to the nominees, that their policies are far more reasonable than what was discussed on the campaign. I have no inside information on this. I personally think all the threats against Canada were a negotiating tactic to just make sure that we could, quote, seal the border. Now but none of us know. But we think the certainty of it, the certainty of Trump taking power and his nominees taking power, and instead of just threats, it will be actual actions. We think it won't be nearly as bad as people think. Plus, we also believe inflation comes from the excessive monetary growth and not all these litany of things people list that has inflation's become sort of the new McCarthyism where you just brand it and try to get rid of policies that you oppose.
So I hear you saying not so much that tariffs don't contribute to inflation, but you don't think the tariffs will be as steep, nearly as steep as Trump has proposed.
Correct. And it's important to make a distinction between a one-time increase in CPI, which is quote inflation, and what inflation really is, which is ongoing increases in inflation. That can almost exclusively is caused by ongoing supply shocks, which almost never happened in the 70s, but almost never happened, and money supply growth. So that's kind of the core of where we come with this. We also believe that if you enhance investment and increase the amount of goods and services, that reduces inflation. So if you think about tariffs, you're raising revenue, that reduces the demand by consumers because they have less to spend. And then the government has more money to either pay down debt or cut taxes on investment. So in the long run, we think it's deflationary, but it's going to be disconcerting, and we don't have the greatest Fed ever created. So it's not clear they would look through those one-time increases as they should.
What about Trump's fiscal policy, where I think there's a significant amount of uncertainty, but I don't think people are expecting an aggressive move to balance the budget?
Well, certainly that would be the case. I think that doesn't just come from the election, but what happened in 2017, there was pretty aggressive tax cuts and not a lot of actually noticeable reductions in spending. But again, that's where versus the campaign rhetoric, because there was no discussion during the campaign whatsoever of fiscal discipline. But if you listen to the appointees like Scott Bessent, he is a deficit hawk. He wants to, we're not going to have a balanced budget, but having a 3% deficit in the U.S. would be a virtual miracle. Now, whether he's fully successful or not remains to be seen, but if at least he's working for that, we have the DOGE, so-called DOGE, efforts. And there's a lot of Republicans in the House that are deficit hawks. So again, we think the reality of the deficit spending is going to be way better than the fears about the deficit spending.
You've referenced Scott Bessent a couple of times. He, of course, is the nominee to be Treasury Secretary, the key cabinet position in terms of stewardship of the U.S. economy. What's your view on him?
Well, we're super positive on him. He's, we're a little bit biased, obviously, because we're in the investment management business. He is as well. We do a lot of macro research. He did that in his career. So he's extremely well qualified, seems reasonable, and is focused on what he should be focused on, the deficit, on increasing energy production, which is deflationary. And if there are tariffs, to have them be thoughtful and reasonable and not, ultimately implement every threat that was made either during the campaign or the transition.
Okay, let's go to your view of the stock market. You are bullish on stocks in 2025. I believe you've got a target on the S&P 500 of 7,000. What gets us there?
Well, it's important to note two things that are conditional. The first is that the bond market rallies significantly, so closer to 4 and not 5%, because every 25 basis points of treasury increase reduces the theoretical multiple on the market by 1 point. So we're assuming 22 times earnings, which is pretty high historically. And we're also assuming a cut in the effective corporate tax rate to 18%, because we're carrying above consensus estimates for 2026 earnings that reflect lower corporate taxes and the follow-on higher growth rates that come from corporate tax rate, which almost no one ever discusses, but growth in earnings comes from retained earnings, and that's driven by after-tax return on capital.
Some of the stocks you like, and the banks have been very much in focus over the past couple of days because they've rolled out fourth quarter earnings. Most of them have been very strong. Goldman Sachs and Morgan Stanley. So you seem to like the sector. Why are those your two picks in the financials?
Well, we actually like those stocks, and they're the biggest positions in our large cap dividend fund, ICAP. But we like them all year, and they worked extremely well. So you might say, oh, they're getting expensive. But this year, or rather 24, was pretty good for investment banking, but mostly because of fixed income. In fact, that rates, at least for most of the year, were lower, a lot of issuance. But M&A continued to lag, and we really haven't had any significant AI IPOs. So we think those two factors will kick in, and we'll have investment banking similar to the situation we had in the late 90s, which was really the heyday of investment banking, where you really, all these big investment banks are firing on all cylinders: wealth management, IPOs, fixed income issuance, and M&A.
Jay, thank you for this.